Hey everyone, welcome back to Corporate Decoder today. Prudential Investment Portfolios 3 just filed their semi-annual shareholder report, and I am seeing a clear picture of evolving investment strategies. Quick note, this is not financial advice, just my take on public filings for educational purposes. The big takeaway is how they are managing their assets and what that means for the fund's future performance. So these reports, called N-CSRS filings, give us a peek under the hood of investment companies. This particular one is for the PGIM Real Assets Fund, and it covers the period from November 2025 to April 2026. It is essentially a snapshot of how the fund performed and what it holds. Now, for individual investors, understanding where your money is going is crucial. This report breaks down the fund's composition by asset class, and it gives us a look at the costs associated with investing. For example, if you had hypothetically invested $10,000 in the class of shares, the costs for this 6-month period were around $34, or 0.64%. The Class C shares, on the other hand, cost about $72, which is 1.34%, and the Class Z shares, which are usually for institutional investors, had much lower costs at just $15, or 0.28%. This shows how share classes can significantly impact your returns over time. Let's look at some key statistics as of the 30th of April 2026. The fund's net assets, meaning the total value of everything it holds minus its liabilities, stood at a little over $50 million. That is the total pot of money managed by the fund. The number of holdings, which tells us how many different investments the fund has, was quite small at just 9. A low number of holdings can sometimes mean a more concentrated portfolio, which can be riskier, but also potentially more rewarding if those few investments do well. The portfolio turnover rate, which is how often the fund buys and sells its investments, was 27%. This means that, on average, about a quarter of the fund's holdings were replaced during this period. A moderate turnover rate often suggests a strategy that isn't excessively trading, aiming for more long-term investments. Now, let's dive into what the fund actually holds. This is where it gets really interesting. The biggest chunk, 26.6%, is in real estate. Then comes TIPS, which are Treasury inflation protected securities, making up 22.4%. Commodities are a significant part at 21.6%. Utilities and infrastructure account for 14.5%, and natural resources are at 8%. Finally, there is a small slice of 5.6% in exchange, traded funds focused on commodities, and a tiny 1.1% in affiliated mutual funds for short-term investments. The remaining 0.2% is in other assets. This mix suggests a strategy that is looking for returns from a diverse set of real asset-related sectors, possibly aiming to hedge against inflation and volatility. Looking at the schedule of investments, we see more specific details. The fund is heavily invested in its own affiliated mutual funds, which is an interesting strategy. For example, PGIM Select Real Estate Fund, Class R6, holds about $10.9 million. And PGIM Tips Fund, Class R6, is valued at over $11.3 million. It also holds a significant amount in PGIM Quant Solutions Commodity Strategies Fund. Class R6, valued at close to $10.9 million. This heavy reliance on affiliated funds means the fund is essentially investing in other funds managed by the same parent company, PGIM. This can sometimes lead to potential conflicts of interest, as the fund manager might have incentives to favor certain internal funds. The fund also holds Spider Gold Minishares Trust, which is an exchange, traded fund that tracks the price of gold. This gives it direct exposure to gold, and importantly, there is an investment in PGIM Core Ultra Short Bond Fund, which appears to be a stable cash, like investment for managing short-term liquidity. Let's move on to the fund's balance sheet, its statement of assets and liabilities as of the 30th of April 2026. The total assets are just over $50.8 million, while liabilities are relatively small, around $212,000. This results in the net assets of just over $50.6 million, which we saw earlier. The breakdown of net assets is interesting too. Shares of beneficial interest at par are very small, just over $4,000. The majority of the net assets, over $61 million, is in paid. In capital in excess of par, this indicates that the fund has issued shares above their nominal par value, which is standard practice. However, there is a significant negative number in total distributable earnings or loss, showing a deficit of over $10 million. This means that historically, the fund's net investment income and realized gains have not covered its distributions and expenses, leading to a cumulative loss from operations. Now, for the income statement, the statement of operations for the 6 months ending the 30th of April 2026. Net investment income was positive, at about $1.9 million, largely driven by dividend income from affiliated funds, which was over $2 million. However, when you look at expenses, they were significant. Management fees alone were over $233,000. Total expenses before any waivers and reimbursements were around $412,000. But here is where it gets crucial. There were substantial fee waivers and expense reimbursements totaling over $319,000. This means the manager is effectively subsidizing the fund's operations to keep costs down for investors. Without these waivers, the net expenses would have been much higher. The fund saw strong gains on its investments during this period. Net realized gains on investment transactions were over $6.5 million, and there was also an increase in unrealized appreciation of over $2.3 million. This resulted in a substantial net gain on investment transactions of over $8.8 million. Combined with the net investment income, the total increase in net assets from operations was a very healthy $10.7 million. This is good news, showing the fund's underlying investments performed well during this reporting period. Looking at the financial highlights for class of shares, the net asset value per S-share started at $10 and ended at $10.91. This shows a positive growth in value. The total return for the 6 months ended the 30th of April, 2026 was a solid 16.97%. This figure represents the overall performance, including income and capital appreciation, assuming dividends and distributions were reinvested. It is important to note that this total return does not include sales loads, which can further reduce an investor's actual return. For Class C shares, the net asset value per S-share went from $9.9 to $10.77. The total return for the same period was 16.46%. While still strong, it is slightly lower than Class A, which is expected given the higher expense ratio for Class C shares. The higher costs for Class C are meant to cover higher distribution and service fees, which often come with a higher sales charge or ongoing distribution fees. Class Z shares, typically for institutional investors and with very low expenses, saw their net asset value per S-share move from $10.03 to $10.94. The total return here was 17.12%, which is the highest among the retail share classes. This highlights the significant impact that lower fees can have on long-term investment performance. And for Class R6, which are often used in retirement plans, the net asset value per S-share went from $10.02 to $10.93. The total return was 17.19%, also very strong and competitive. The low expense ratios for Class Z and Class R6 are a key advantage for investors who can access them. Looking at the ratios, the expenses after waivers and CHIO expense reimbursement for Class A shares for the 6 months ended the 30th of April 2026 is listed at 0.64%. This is the actual cost to the investor after the manager has kicked in some money to cover expenses. Now, the expenses before waivers and CHIO expense reimbursement is a much higher 1.69%. This substantial difference shows that the fund is heavily relying on its manager to keep costs down. Otherwise, the cost would be more than double. This is a critical point for investors to understand the stated expense ratio is after these waivers. And if those waivers are ever removed or reduced, the cost of owning this fund could go up dramatically. The notes to the financial statements are where we find a lot of the real juicy details. For example, under Organization, it mentions that the fund has a wholly owned subsidiary, the Cayman subsidiary. This subsidiary is used to invest in commodities and other instruments that might be difficult for a US registered fund to invest in directly. This is a common strategy to gain access to certain markets or gain tax advantages. The note also states that as of the 30th of April 2026, this Cayman subsidiary held about 5.62% of the fund's net assets. This means a significant portion of the fund's exposure is through this offshore entity. Under the agreement section, we learn about the management fees. The contractual management rate is 0.60%, but the effective management fee before any waivers is listed as 0.64%. This slight difference might be due to how the fees are calculated or how the Cayman subsidiary's assets are factored in. The notes also clarify that the manager has contractually agreed to limit total annual operating expenses through February 2027. This is a good thing for investors, providing some certainty about expenses, but it is always important to remember these agreements have expiration dates. The fund also has a distribution agreement with Prudential Investment Management Services LLC, or PIMS. For Class A shares, the gross distribution fee is 0.30%, but the net distribution fee after any agreements is 0.25% for Class E shares. The gross and net distribution fee is 1.00%. This explains why Class E shares are more expensive. They have higher ongoing distribution and service fees. This section reveals that the fund uses affiliated companies for services like transfer agent and shareholder servicing. For instance, Prudential Mutual Fund Services LLC is the fund's transfer agent, While using affiliates can sometimes lead to cost savings, it is also important to be aware of potential conflicts of interest. The fund also invests some of its overnight sweep cash in another affiliated fund, the PGIM Core Ultra Short Bond Fund. This is a common practice for money market funds or cash management vehicles. The Portfolio Securities section shows the cost of purchases and proceeds from sales of portfolio securities. For the 6 months ending the 30th of April 2026, the cost of purchases was about $18.6 million, and proceeds from sales were around $47.6 million. This indicates a net outflow from securities sold, suggesting either a reduction in overall holdings or a rebalancing of the portfolio. The tax information provides details about the fund's tax basis and unrealized gains or losses. As of the 30th of April 2026, the net unrealized depreciation on investments was over $8.4 million. This means that the current market value of the fund's investments is lower than their cost basis, resulting in a paper loss. On the plus side, the fund reported a capital loss carry forward of $8.598 million for tax purposes. This is valuable as it can be used to offset future capital gains, potentially reducing the taxable distributions to shareholders. Under capital and ownership, we see that the fund offers Class A, CZ, and R6 shares, each with different features and fees. Class A shares have a front-end sales charge. Class C shares have a contingent deferred sales charge, and Class Z and R6 shares have no sales charges. It is also noted that as of the 30th of April 2026, Prudential, through its affiliates, owned a very small number of shares, just 1,020 in Class R6, which is less than 0.1% of outstanding shares. This suggests that the fund is primarily owned by external investors, not by its own management. Interestingly, there are 7 unaffiliated shareholders holding a significant 92.3% of the outstanding shares. This could indicate a large institutional investor or a small group of major shareholders. Now, let's talk about the risks. The filing lists quite a few of them, and it is essential to understand these before investing. There is affiliated funds risk, which we touched on, where the fund invests in other funds from the same manager, creating potential conflicts of interest. Then there is commodity risk. The inherent volatility of commodity prices, Cayman subsidiary risk, highlights the complexities and potential regulatory issues associated with using an offshore entity. We also see interest rate risk, the classic risk that rising interest rates can hurt bond and even stock valuations, and liquidity risk, the danger that the fund might not be able to sell its investments quickly enough to meet redemption requests without taking a big loss. The market disruption and geopolitical risk section is particularly relevant today, given global uncertainties, events like wars, trade disputes, or even natural disasters can significantly impact investment values. And here is a really important recent development under subsequent event. On the 10th of June 2026, the Board of Trustees approved a proposal to liquidate all assets of the fund and redeem any outstanding shares on or about the 21st of October 2026. This means the PGIM Real Assets Fund is shutting down. This is a significant event for any investors holding this fund. They will likely receive their money back based on the fund's net asset value at the time of liquidation, but it also means they need to find new investments. This liquidation could be due to various reasons, perhaps a strategic decision by PGIM, a lack of assets under management, or changing market conditions. Based on this filing, the PGIM Real Assets Fund presented a strategy focused on real assets, utilizing a mix of commodities, real estate, and inflation. Protected securities, often through affiliated funds and a Cayman subsidiary. The fund demonstrated strong performance in the 6-month period ending April 2026 with significant gains on its investments. However, the large capital loss carry forward and the substantial expense waivers indicate past challenges in generating enough income to cover costs, making the manager's expense subsidies crucial for current investor returns. The most critical piece of information, however, is the planned liquidation of the fund. This means investors need to act quickly to manage their positions and find alternative investments. The risk I am watching closely is what ultimately triggered this liquidation. Was it a strategic shift by PGIM, or were there underlying issues with asset gathering or performance that made continuing the fund unsustainable? The liquidation date of the 21st of October 2026 gives investors a clear timeline to plan their next moves. Alright, that is my take on Prudential Investment Portfolio's 3's latest filing. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.